should start by saying the West Midlands really, largely I think, due to the efforts of Melanie and others in this room, really does set the standard in terms of bringing social enterprises together, helping them to share best practice, I think illustrating some of the value that some of the great social enterprises that exist in your community, and also allowing the social finance intermediaries to have access and to start a dialogue with you. And we said this a year ago when we were here, that it really is Melanie and others here are doing a really terrific job in that respect. So it's a real pleasure to be back here. I wanted to talk a little bit about big society capital. Some of you, I see many familiar faces in the audience who will have heard some of this before, so I won't go into too much detail about how we actually work. Our annual report is over there, and that I think gives a pretty good overview of what we spent the last year or so doing. But I did want to reiterate that the role that we have is to try to increase the supply of capital to social enterprises. And not just any form of capital, but capital that is accessible, capital that's affordable, capital that's provided by organizations that really understand what it is that social enterprises do, and most importantly, that actually put a value on that and on the social value that you create. And we believe that if we can do that, that we can build together a stronger and more bigger and more resilient social enterprise community in this country. And as Jack has already laid out, the social enterprise community in this country is critical to the growth and prosperity and quality of life in our community and society. So that's what we're here to do. Why does it make sense to have a social investment market? From an investee's perspective, and by investees I mean those frontline organizations, those social enterprises that actually access capital, social investment provides a new form of capital. It's not intended to be an alternative to grants. It's a new source of funding. It comes from a different type of investor, and they're doing it in order to supplement and complement any grant making or donations that they may be making. So it has to be additive and incremental. It fills many forms of social finance can fill an important financing gap, particularly for programs that are focused on early intervention, innovative programs focused on early intervention, and particularly for social enterprises who really want development capital to grow. The provision of social capital, I think, does change the way in which a social organization is managed and governs itself. It strengthens basic governance and accountability, but also importantly, I think it gives, and we hear this over and over again from charities and social organizations that access social investment, that it actually gives the organization themselves a lot more autonomy and authority in how they deliver their program. So as opposed to grant programs, which tend to be very prescriptive in how a program is delivered, social investment tends to be a lot more flexible and gives a lot more discretion to the underlying organization as to how they deliver a program and how they generate positive social results. From the investor's perspective, and whether it's an individual investor or an institutional investor, the biggest advantage is that it is capital that's recycled. It's capital that's repayable. You get it back and you use it somewhere else. And that's obviously an important element of the whole social investment process, is that it's repayable capital. And it's repayable capital that is used again and again and again to address different social issues in different parts of the country. It allows investors to have a deeper engagement with the social sector and with the community as a whole. And I think it helps to shape a new and more responsible form of capitalism, not only because it grows the social enterprise sector itself, and Jack touched on this in his remarks, but it also sets an example and sends a message to the broader commercial sector that there is a need and a value to behaving in a more socially responsible way and being clearer about the social impacts of the work that you do and the jobs that you create and the products and services that you provide. Big society capital Again, many of you will have heard this before, but I'll just cover it very quickly. We were set up, originally the idea originated about 10 years ago under the previous government, who also passed the Dormant Accounts Act in 2007, which really facilitated the creation of big society capital. We're funded by dormant accounts. We think to date there have been about £600 million of dormant accounts transferred to the Reclaim Fund. That money is freed up over a period of time, but we expect to receive about £100 million a year, at least for the next 4 or 5 years. And in addition, there's a further £200 million that have been invested by the big 4 high street banks. And that money is used to provide support and funding for what we call social investment intermediaries. And social investment intermediaries, I'll talk about again in a second. We have 13 great examples around the room here. They are organizations that engage directly with frontline organizations and social enterprises to provide them with investment capital. And our role is not just confined to being an investor ourselves. We are meant to build a market, not be a market. So our challenge is not only to provide capital to some of the intermediaries that you see around the room, but also to encourage and help facilitate other organizations, other investment organizations, to provide capital. And in the year and a half or so since we've launched, we've seen a big increase in the range of other co-investors, if you like, people who are prepared to match or come alongside our investment. And they include mainstream commercial investment organizations, but they also include charities who have surplus funds. They include some housing associations in certain transactions. So they include companies, regular corporates. So there's potentially a much broader range of potential investors who can provide capital to social enterprises, and we want to try and catalyze that and accelerate the growth of that. We also have an important role as a champion of the sector. So most of you will be aware that the government have committed to a tax relief for social investment, which will be the details of which the consultation, which took place in the summer, the details of the tax relief will be available in the autumn statement. And we think that's will provide an important incentive for individuals, particularly individuals, to invest further capital in social enterprise. We also work on a number of other government initiatives around investment readiness. We work with the EU on their social business initiative. And so in a whole host of different areas, we are actively trying to promote the interests of social investors, social investment, and social enterprise in the social economy. As I touched on the intermediaries, and as I said, we've got 13 examples of intermediaries around the room. The ones that you will be most familiar with, and I prefer now, rather than talk about intermediaries, I prefer to talk about our partners, the people who actually interact directly with frontline organizations and make the capital available to them. And our ambition is to have a broad range of different partners in different parts of the country with expertise in different social sectors, and providing different types of capital to different types of organizations. So the ones broadly they fall into 3 categories. One are social funds, and you'll be familiar or will have heard of organizations like Bridges and Big Issue through their Social Entrepreneurs Fund. Our ambition is to create more of those type of funds that provide more typically larger risk capital, equity type capital to social enterprises. The second type is social lenders and social banks, and that's Unity Trust, that's Charity Bank, that's Triadis, that's Asset Reinvestment Trust. So organizations that have a balance sheet and use that balance sheet to make loans to social organizations. And our role there is to provide them with additional capital. Sometimes to lend on directly, sometimes as a form of capital which allows them to draw in more deposits and then hence have a bigger balance sheet. And the third type of intermediary broadly that we support are social impact partnerships. Those are special purpose companies that put together specifically to deliver a social impact bond, which is a way of, as I think most people will be aware of funding charities to participate, particularly in payment by results contracts. And the intermediaries' role, as I said, is to evaluate the different frontline investment opportunities. So they're going to make a judgment when you come in the door as to whether or not they consider you effectively a good risk and at what price they're willing to make the capital available. Not everybody who walks into any of these institutions is going to be necessarily guaranteed of getting a loan. And that, again, as Jack pointed out, that's why it's so important that social organizations present themselves in the right way to these lenders, and they do that with a robust and credible business plan. And one of the things that government has been doing, I think, quite actively is providing additional support to help social organizations become investment ready. And a big part of that is developing a business plan that would be marketable to a social lender. The intermediaries are also responsible for monitoring social performance, and my colleague Caroline Mason will talk later on this morning about how we look at that and how we encourage social impact measurement. They provide a risk diversification effectively, and they also have a role in working to raise additional capital, sometimes from us and sometimes from others. Our own decision about which intermediary we invest in is driven by three different elements. One is its contribution to the market development. Our basic mandate is to grow the social investment market. And as I said, the reason we do that is because we think by doing that, it will create, we can help fund social organizations to create substantial social value. So we need to know, number one, that funding a particular organization will help in the overall development of that market. We need to know that if they're funded, that the organizations that they in turn fund will create social impact and social value. And that's why the measurement and the evidencing of social impact, both from the intermediary and also from the ultimate beneficiary of the funding, is important. And as I said, Caroline will talk about how we do that. And then thirdly, we look at financial performance, because we're set up as an organization that's intended to preserve its capital. And that means we don't have the sort of return requirements that obviously the commercial banking institutions have, but we do have an obligation to try to preserve our capital. So when we put money out to organizations, we need to believe that we will get it back. And so that element of financial performance is the third thing that comes into our decision as to which intermediary to support. Since we were launched in April of last year, we have committed about £140 million to about 25 different intermediary and partner organizations around the country. And they're detailed, or at least the first year's activity is detailed in more, you can find in more detail in our annual report. Broadly, what our investment portfolio falls into 5 different categories. We have funds that are what I would describe as issue specific. So we are in the process of funding 2 organizations to support social enterprise in the health sector. We believe that having the expertise around how healthcare in this country is organized is important in terms of being able to access and find transactions. And so there's a value in having specialized organizations and specialized funds to do that. So we have 2 funds that do that. We have funded 2 organizations to lend to help communities develop energy sources, so clean energy sources. So I think Robert will speak from Pure. Robert will speak later on. And they lend small amounts of money, less than £100,000, to so far a dozen or so communities around the country that help them, put solar panels on the roof of the swimming pool or whatever. And this is money. These are organizations that would not be able to access finance from normal commercial banks, because they are community organizations. They have no assets, or rarely have assets to pledge, and they are often have very limited operating history. So they're not the sort of organizations that would get normal finance. And that's, I think, a good illustration of our role to fund organizations like Pure, like Robert, people like Robert, to help them identify and fund those communities. We have regional funds, which we've already announced that we're working with the Northern Rock Foundation to launch a social investment fund in the Northeast. We are also talking to Social Investment Scotland about launching a fund that will support social enterprises in Scotland. We have an ambition to have multiple other regionally focused social enterprise lending organizations, and I do think it's absolutely critical that we have regionally focused organizations that understand the particular needs and know the individuals and so on in the community. We are a funder of social impact bonds, and to date we've had in the UK about 14 different social impact bonds. They have covered issues as diverse as recidivism, keeping children out of care, helping NEETs become more employable, addressing homelessness in London, and helping to increase the prospects for hard-to-adopt children. So it's a whole range of different social issues. Each one of those is the service, the delivery is provided by a different charity. And I think the results from the early social impact programs, and by results I mean the social outcomes that are being generated, are again, very early stage. It takes a while to see how to actually see the outcomes and to measure them. But the early results from Peterborough and the recidivism program, from a couple of the programs that we funded through the DWP Innovation Program in Liverpool and another one in London, through the homelessness program in London, the results are that this method of financing seems to be helping to get results that are well ahead of expectations and benchmarks. We fund operating intermediaries, so organizations like the Social Stock Exchange, like Clearly So, which is an organization that raises capital for social enterprises. And then we fund a broader social entrepreneurs funds run by people like Nesta, which is a fund we launched together with them about a year ago, run by people like Bridges or Big Issue. And they provide, typically focused on larger growing social enterprises, more sort of equity, unsecured lending or equity type funding. So I talk for a second about who can access social investment. I think we tend to think of the sort of the investee community in three broad groups. The first one are charities, and charities. Why would a charity want to access social investment? Because they want to purchase an asset, because they want working capital to bridge to perhaps the payment of a government contract, because they want to deliver against a payments by results program where the payment is often comes later and there's often a certain risk associated with the outcomes risk associated with the payment, or because they want to develop an enterprise, and that enterprise can be as simple as increasing the number of charity shops, or it can be in the case of Catch-22 to develop a small chain of auto repair shops to help employ the people that the individuals that they were training. So there's a number of different reasons why charities might want to borrow, and they borrow. Sometimes they have an asset to pledge, and they can borrow on a secured basis. I think that's a relatively easy. That market functions reasonably well. I think the market that doesn't, particularly for larger sizes of loan, I think the markets that don't function well are where you don't have an asset to pledge, where you're borrowing effectively against future cash flows, where those cash flows are often uncertain. And in those cases, and particularly if the amount is smaller than, say, as Melanie highlighted, a couple of £100,000, and that particular area is an area we've spent a significant amount of time trying to understand. We're funding two different organizations to try and specifically address that, and those are our funds and pools of capital that will be launched in the next before the end of the year. So that's charities. The other different sort of groups are community organizations, and we think there's a significance. Some of the recent legislation that's been passed has made it a lot easier for communities to buy assets. In order to buy assets, you need to do pre-feasibility work, you need to do feasibility work, you need to actually buy the asset and then operate the asset, generate a cash flow, and if you've taken a loan against it, you need to be able to repay the loan. Organizing, providing one-stop shop. Well, that requires a combination, a package, a cocktail of both grants and loans. And so we're working as was announced by the Prime Minister a couple of months ago, we're working together with the Big Lottery Fund to set up a pool of money that would allow communities from around the country to access both grants and loans from the same organization and take their project from very early stage to actual completion and operation of the asset. And we think that putting more assets and helping communities to, supply energy services or help or providing them with funding to help regenerate their communities is a critical, and regenerate communities in a way that puts the assets of the community in community ownership is a critical part of what we've been set up to do. And the third category is social enterprise. And social enterprises can be organized as community interest companies, or occasionally under certain circumstances as what we would describe as social companies, which are companies that look like, from a legal form perspective, like regular companies, but actually but operate principally with or as the Dormant Accounts Act says, wholly or mainly for social purpose. And trying to provide capital for them, development capital so that they can grow, or capital so they can purchase assets, is another important part of what we are trying to do. Looking forward a little bit in terms of key developments over the next sort of 6 months or so, I think you will, as I mentioned earlier, get an announcement of a social investment tax relief in the autumn statement, and that is a firm commitment by the government that they will announce something. Now, whether that is something that is actually practical and workable, we will see. But we are hopeful, and we've been very involved, as have others I know in this room, been very involved in the dialogue with government around what that relief should look like. And at the very least, it's going to start the process of putting social enterprises on a more level playing field with commercial organizations. I mean, it is absurd that you can, as an investor, get a 30% tax relief for investing in a commercial for-profit company, and you can get nothing for investing in a social enterprise. And that's the issue, I think. Again, to be fair to the government, that is an issue that they have recognized and they are trying to address through this tax relief. And they are specifically trying to help the provision of riskier capital. So, as I said, there's a less obvious market failure in the provision of secured capital, but a very obvious failure in the provision of riskier capital. So, hopefully, we will tax relief will help to address that. We expect to see the launch of what social ISAs. I mean, it is again, we believe there's an enormous number of savers in this country who would much rather have their money in a fund where the assets of that fund are used to support charities and housing associations and schools and hospitals, rather than for-profit companies. And we think, we've said before, that we expect to see social ISAs launch before the end of the year, and we still expect to see social ISAs launch before the end of the year. And I think they'll be launched by a partnership of mainstream fund managers that have the distribution access to savers, in partnership with more specialized social investment organizations that are ensuring that the assets that are purchased by the fund really meet the social criteria. I mentioned the Community Assets Fund, which is something we're working directly or jointly with the Big Lottery Fund on. I think that will hopefully be launched sometime early next year. We expect to see further support for investment and contract readiness. There was a pool of money, £10 million, that the government put up for helping to support social organisations to develop and become investment ready. We expect and hope that they will put up more money next year. We think it's important that they do, because we think that program's been relatively successful. In addition to the community assets program I mentioned, there's a couple of other initiatives that we're working on with the Big Lottery. I mean, it is obvious that the development of social enterprise cannot be done, development of social investment cannot just be done by our pool of capital, given the restrictions that we have on it, and it needs a blend very often of grants and investment capital. And obviously the Big Lottery Fund is the largest grant maker in this country by a substantial margin, and can play an important role in that, and our partnership with them is critical. And then we're working with a group of other social organizations led by SEUK to help encourage all the major parties to take an active position on developing social investment and social enterprise in their manifestos. And the next 12 months, 15 months will be critical in in that process. So I think I'll stop there. For those people who are seeking social investment, if you're an intermediary, meaning you provide funding to somebody else, then you can potentially access big society capital directly. If you're a social enterprise and you want to know who are all these intermediaries, I need a roadmap to figure out who they are and who's active in my area and what they do, then there is a director of intermediaries also on our website which you can use to help you find them. So I think I'll stop there. Again, I want to thank Melanie. I want to thank all of you for coming. Melanie, particularly, for organizing this event so successfully again. And hopefully, this is, as Melanie said, the third time that I've been here talking about big society capital. I think we've made good progress in the first year and a half or so of our life, but I do think there's still a lot more to do. As Melanie said, there is actually quite a substantial amount of money out there and becoming more available. And what we need now is to work with social enterprises to help them understand better how they can access that capital and how they can use that capital to generate real social value in their communities.